Great to be.
I mean, it's a pretty dire picture, isn't it? We're going to get a better indication, I guess, with the PMIs coming out of China starting from today. But that's expected to really show that growth and demand out of China may have peaked for this year.
That's probably part of the key story. We've been getting a very strong level of growth through China through the last 6 to 9 months. And coming through the next probably 6 months, we're going to see that weakening. So the PMIs today probably are going to likely show that the growth in demand, particularly for the manufacturing and construction side of things, are coming back from their recent highs. So I think that's a very key point in how we're trying to pick the turning point. But we're not talking about a sudden collapse in growth or anything. It's more like an easing back. So even in that environment, you're not going. It shouldn't, in the near term, set off the targets for a rapid correction in commodity prices.
What does this essentially mean?
I'm just going to jump in really quickly here on iron ore prices. I want to bring up this chart here about iron ore and slumping into this bear market. Obviously much of this affected by the production we've seen, the capacity, the inventories out of China. Seems like we're slumping. We're slumped into a bear market. So, where is the price? Where do we find that bottom?
That's a very good question. So if you're trying to find, at the moment, the markets are telling us that there's a slight imbalance coming through in terms of the seaborne trade, which is pushing on the prices. Now, if the imbalance gets too large, and let's say they really try to unwind all those levels of inventories that they've built up in China, well, in the short run, the price would have to fall to a level that would create a meaningful correction in demand, in supply. Now, you're talking about Australian iron ore miners being able to deliver into China somewhere in the vicinity of $30 to $40 a tonne. So in the short run, you can get shocks if the market gets so imbalanced enough that it needs to do a more rapid correction of down towards that sort of sub $40 a tonne mark. That's probably where you find the real turning and pain points that lead to a correction.
Justin, what sort of surprised me is how sanguine the Aussie dollar's been to all of this, given all of the increasingly bearish signals when it comes to iron ore and how closely correlated we all know growth in the Aussie dollar is. I want to just throw up this chart, 63.94, and you are seeing a little bit of that sort of divergence when it comes to Aussie versus iron ore prices. Do you think that is going to start tracking a little bit more closely? I mean, we have had projections towards 70 US cents this year, potentially with further downside risks.
In terms of the Aussie, what you're sort of finding now is we've seen the Aussie for quite a long time trade above what you would think would be going with fundamentals. So iron ore's been part of the story, but it's other commodities, the relative interest rates, the relative growth and risks. So Aussie's fallen back to what you'd think would be more around the long-term fundamentals. So it's trading at its fair value. Now, if you want to see Aussie dip even more rapidly with iron ore prices, you'd have to sort of see that negative sentiment about Australia go even deeper. So you need something more than just pure an iron ore play. You'd have to see iron ore then lead on to, say, greater stress in the Australian economy, much more weaker incomes, talk of the RBA cutting rates quite rapidly in the near term.
If we lost that rating, then it would have...
That's right, and the rating too. The loss of the rating would also push us down the risk level as well. So our view is the Aussie is going to keep on trading lower. We are looking for numbers in the 60s as we get in towards 2018. But for the near term, without that sort of major move in commodity prices, but I think you're right, if you get a big leg down in iron ore prices, it would be part of the sentiment story that would drive the Aussie lower.
Justin, given that it looks like we are going lower here, with these prices, I'm curious, what do these weakening prices do? I mean, how is that going to change the dynamic here? I mean, what does that mean in terms of, let's say for China and their inventories and selling off their inventories? What happens?
That's the main, but they talk about that inventories is the most interesting one, and that's probably the one that makes me a little nervous about the balance in the market. If we get a meaningful correction in iron ore prices that lead to the holders of the inventories now realising that there's ongoing losses rather than ongoing gains or stabilities, and particularly in the sense that if those losses are bigger than any gains they can make from a currency play of rising value of the US dollar or the declining value of wine, you see the much larger correction in prices. So for me, that is going to be the trigger point. And it's really hard to know when that pain point is reached that would lead to that big unwinding of those inventory stocks. But I think you're right. That's going to be the tipping point that sort of leads to it. It is more interesting too in the sort of bigger picture of what it means for the Chinese economy, because China is on both sides of the equations, being a producer and a consumer. It's more of a consumer than a producer. So falling commodity prices, rapid falling iron ore prices will improve mill margins and will help improve steel production and what you'll see in terms of margins being produced, and help deflate the sort of upside risk that we've been seeing from commodity prices to flow through the PPIs in China as well. So there is some positives if it's driven purely from a supply story or inventory correction of lower iron ore prices for China, rather than just what a crash in price means.